You have paid this every month for 6 years. You have never touched it. The number is bigger now than the day you walked out. So look at what you actually signed. They handed you a sum. You agreed to hand back a slice of what you earn, but only the part above a line. Earn under the line, you pay nothing. Over it, a percentage. Plan 2, income-driven, deferment. Same machine. And most people stop reading right there, because that does sound fair. It would be, if the number sat still while you paid it. It doesn't. Every single day, interest is added, not to the part you haven't paid yet, but to the whole outstanding balance. Which means there are 2 flows here, not one. Money leaving you every month, a slice of your salary, capped by law. And money being added every month, a percentage of everything you owe, uncapped, growing with the balance itself. Now hold those 2 side by side. Somewhere there is an income where they are exactly equal. Call it the crossover. Earn above it, and your payment eats the interest and starts on the balance. The debt falls. Earn below it, and the balance does not fall slowly. It does not fall at all. It rises, while you pay it. 10 years of payments, never missed, and you owe more than the day you started. That is not what happens when you default. That is what happens when you comply. And notice which way it cuts. The graduate who earns well crosses over, clears it, and stops paying. The graduate who earns less pays every month for 30 years and never clears anything. Same debt. The one with less money pays longer and pays more. Then, decades in, the balance is written off. Which sounds like mercy. It isn't. It's the pricing. The lender's own forecasts already assume a large share of borrowers will never clear the balance. The write-off isn't the escape hatch at the end of the machine. It is a line in the machine's own budget. And this is exactly what the prohibition is pointing at. Riba isn't a tax on borrowing. It is a price charged for time. A number that grows because the clock moved, not because anything was built, sold, or risked. A debt you service faithfully and cannot reduce is the purest version of that there is. So here is the 2-minute check. 1. Find 2 published numbers, your interest rate and your repayment threshold. 2. Work out 1 month, interest added against payment taken. If the interest is bigger, you are renting the debt, not repaying it. 3. Only then decide about overpaying. Above the crossover, it genuinely shortens it. Far below, and written off anyway, it is money burned. Same arithmetic, both directions. And for the ones coming behind you, Khawt Hassan funds, employer tuition schemes, paying as you study. Smaller, slower, less convenient. Also not this. You didn't fail to pay it off. You were never paying it off. The Money Machine Decoded.